The key question is, you see the return, you must ask, how much risk did the manager bear to get that return? Now let's look at this range of managers. What we posit is that the market is up 10% or down 10%. Now let's look at some individual managers. The first one is up 10 when the market's up 10 and down 10 when the market's down 10. Accomplishes nothing. You might as well have invested in an index fund that emulates the performance of the market. No skill, no value added. Now let's look at the second one. Up 20 when the market goes up 10, down 20 when the market goes down 10. No skill, no value added, just a lot of aggressiveness. Well, what about this one? Up 5 when the market's up 10, down 5 when the market's down 10. Again, no selection ability, no discernment, no value added, just defensiveness. You don't need help in achieving that, and you sure shouldn't pay a lot for it. But what about the next one? He or she is up 15 when the market's up 10 and down 10 when the market's down 10. So in other words, market type losses on the downside, but superior gains on the upside. Value added, what I call asymmetry, does better in the good times than does poorly in the bad times. But what about this one? And I think this is the most interesting, and I think maybe it characterizes me, maybe it characterizes Oaktree to some extent. Up 10 when the market's up 10, down 5 when the market's down 10. So market type gains in the good times, I personally think that performing with the market when it does well is good enough. And that's almost all the time. Nobody should have to beat the market when it does well. But if you can do that and at the same time be ready to decline less when the market has its down spells, I think that's accomplishing something very important. I believe that risk is not volatility. The academics developing investment theory, largely at the University of Chicago in the early 60s, just a couple of years before I got there, adopted volatility as their measure of risk. I believe they did so largely because volatility is readily quantifiable and nothing else is. I think that volatility can be an indicator of the presence of risk, a symptom, if you will, but it's not risk itself. So if risk is not volatility, then what is it? And in my opinion, and in the real world sense, risk is the probability of loss. I think this is what most people mean when they say risk, and I think that this is what people demand compensation for if they're going to bear it. Nobody sitting around at Oaktree says, well, you know, we shouldn't make that investment because it might be volatile, or because it might be volatile, we should demand a higher return. No, they say that about the possibility of loss. We're not going to make that investment because the possibility of loss is too high, or because of the possibility of loss, we're going to demand a risk premium in terms of the return. This is risk, the possibility of loss. Now, another important question is risk quantifiable in advance? And I believe it's not. Like most things occurring in the future, risk cannot be anything except a matter of opinion. I was writing my first memo about risk in 2006. I wrote about my belief that risk is not quantifiable in advance. And then I hit the return key and went on to the next section and wrote something I had never thought about before. My belief that risk is unquantifiable even after the fact. And I think this is a fascinating topic. You buy something for $1, and a year later, you sell it for $2. Was it risky? And the interesting thing is that you can't tell from the outcome. A profitable investment may or may not have been risky. Was it a safe investment that, in the case of my example, was sure to double? Or was it a risky investment where you got lucky in terms of the outcome? And as I say, you can't tell from the outcome. The bottom line is, to me, it's impossible to quantify risk in advance or even in hindsight. The possibility of loss is not the only form of risk. There are lots of forms of risk. My last memo on the general subject, it's called Risk Revisited Again. And I talk in there about 24 or 25 different forms of risk, some serious, some facetious, some important, some less important and obscure, but still it comes in many forms. The risk of missing opportunities is another important risk. In other words, if you think about it, the risk of not taking enough risk. Another really important form of risk, I think one of the key risks in investing, is the chance of being forced out at the bottom. Which is a bigger mistake, buying at the high and seeing a decline, or selling out at the low and missing out on the recovery? Clearly, it's the latter. If you buy at a high and you experience a decline, if you're able to hold throughout and not lose your nerve, the next high is usually higher than the last high. The fact that you experienced a downward fluctuation might have been uncomfortable for a little while, but by the time the new high is achieved, you're back to your cost and more. But if you sell at the bottom and miss out on the subsequent recovery, that means you've gotten off the track of investing and may never get back on. In my opinion, selling at the bottom, it's the cardinal sin in investing. Now I want to get a little philosophical. One of my great heroes, Peter Bernstein, probably the best thinker in a philosophic sense and a real investment sage who sadly passed away around 2009, once said, essentially, risk says we don't know what's going to happen. We walk every moment into the unknown. He said there's a range of outcomes, and we don't know where the actual outcome is going to fall within the range. And often we don't know what the range is. So in other words, we have ignorance to varying degrees about what the future holds. And it is from this ignorance that risk ensues. If we knew what was going to happen, by definition, there would be no risk. In the memo that I mentioned before, Risk Revisited Again, there's a great quote that I got from a Peter Bernstein memo. And I thought it was so important that I took it over word for word in my memo. It's from G.K. Chesterton, who was an English writer, and he said the following, and I'm going to give it to you word for word because it's so important. The real trouble with this world of ours is not that it is an unreasonable world, or even that it is a reasonable one. The commonest kind of trouble is that it is nearly reasonable, but not quite. Life is not an illogicality, yet it is a trap for logicians. It looks just a little more mathematical and regular than it is. Its exactitude is obvious, but its inexactitude is hidden. Its wildness lies in wait. In other words, we know what's likely to happen. We know the other things that probably could happen instead. We have little appreciation for the things that are highly unlikely to happen, but could.